Hi, I'm Ashish Shanker, Head Investments at Motilal Oswal Wealth Management. I'm happy to bring to you the next in the series of Know Your 4C Manager. Today we've got someone from the oldest investment house. They started their journey in 2002. In fact, the investment professional I've got with me has close to 24 years of experience across different organizations and has a rich experience in managing equities. We have today with us Prateek Agrawal, who's Chief Investment Officer for ASK Investment Manager, and he's also the business head. I'm happy to have him with us here to talk us through their philosophy, the investment journey, and how he sees markets going forward from here. Welcome, Prateek, to this show. First of all, a very big congratulations for the investment track record that you've cultivated over the last 5-6 years. I mean, your India entrepreneur portfolio has done, I think, close to 27% compounded over the last 5 years.
5 years, yes.
Right. Could you talk us through this journey and what exactly is your investment process and what has worked over these last 5-6 years?
Sure. It starts with what is it that we are trying to deliver to our clients. It is preservation of capital and growth of capital. And how do we go about achieving it? So it is through investing into high quality businesses, free cash flow generating, in combination with a fast, long period compounded growth in EPS. Now this combination is a rare combination. If I just try and explain it in terms of business, you will have a high quality when the business is not giving away so much to the distribution channel, for example, and it is keeping more of the profits to itself.
In terms of trade.
In terms of trade. But then how do you make the trade work for you and sell you? So you can have great quality, but then you may probably not have great growth. That's the usual thing. And hence the combination is extremely rare. And we try and hunt for companies which have this combination sustaining over extremely long periods of time. That preserves capital and grows money in a very, very visible, meaningful manner over a period of time. That is basically what we do. The discipline that is there in the process is helped by the fact that we have parameterized a lot of stuff that we want to deliver. So if we want quality, then we have equated it with ROCs, what is the minimum that we will take. If we want growth, then what is it that is the minimum that we want? And obviously, it is the growth in business that increases the value and makes our investors money. So, simple philosophy, but I do believe, it is execution of that philosophy which actually, makes it look so good.
Fantastic. I mean, in my numerous conversations with you, Bharat Bhai, I've always heard this term that don't compromise on quality, right? Could you tell us, and for the benefit of our viewers, why is quality important?
No, let me reverse it and say that growth is super important.
Right.
And it is impossible to have growth without quality. Okay, so to give you an example which is extremely stark and people will associate with it, try and remember construction companies in 2007.
Yes.
And try and find construction companies today and look at the common names. There would be one common name. The whole pack has changed. Many of the so-called big movers in 2007 are actually NCLT cases today.
Right.
So what was missing? Growth was there, quality was missing. So growth without quality is impossible. So quality is the start point. What most people make a mistake is to hunt for growth without having enough free cash flows. That growth is not sustainable. The business can run for some time on hope, some time on borrowings from the banks, etc. But ultimately, it comes to grief. So quality hence is the start point. There is no growth that is possible without quality.
Great. You've had many successes over the last 5-6 years in terms of the companies you have invested and stayed invested through this journey. Could you talk us through 2 or 3 stories that particularly stand out and can elucidate and elaborate your philosophy?
So, while we can do that, we are not a house that is extremely focused on 1, 2, or 3 name. We want our whole portfolio to work for us, and in that sense, if we drill down through our universe and build a portfolio of 20 names, we would want all of those 20 to work for us. And we have seen a very high degree of success in the final selections that we have made. To give you some examples which help you understand what we do, so over past 8 years, for example, if you look at our house, we would have stayed largely away from public sector bank. In fact, it's not as if we were entirely away. We did invest over our various strategies for a limited period of time into one name or the other. I would believe 5 instances of 1 to 2 month kind of exposures, but by and large did not go there at all. For the simple reason that we were always long period focused, always looked at 3 private sector names, which were gaining market share, which were able to do business in a sustained manner. So, if you look at the pack of 3 names, an HDFC Bank, Kotak and Indus, over a period of last 10 years, and that includes the period of GFC, that includes the period when we had a Eurozone crisis and the banking crisis that the country is grappling with just about at the moment. These businesses have continued to grow as if the world was just all fine. And then if you look at the stock price performance of the same businesses versus others in the same sector, I think the message comes out very clearly as to what we are trying to achieve. Once again, if the numbers come out with a very high degree of consistency, the volatility in the stock prices would be of an order lesser than the industry itself, and if the growth is meaningful, so all of these companies would have done over 20% CAGR in earnings growth over very long periods of time. You kind of assure yourselves of a very meaningful equity kind of returns as well. So I think that's one example, and we can talk about it through other sectors as well. In FMCG, which most people believe is not such a fast growing space, we have been invested into a name like an Asian Paints for a long period of time. It's the largest company in this space. Most people believe the largest doesn't grow so well, but the growth rate of an Asian versus others in the same space over 10 years has been actually the same or better. Being a price leader, this is a company which has been able to make a new all-time high each one of the last 10 years, and this is a space in the market when, apart from a GFC, etc., you saw oil move from a 20 to 120 to 20 to now 80, and the business has continued to do so well. And something similar with the Pidilite kind of a name. So this is what brings out the strength of the business. Simple businesses, but great discipline, great ability to grow the business over a length of time. If the penetration levels are getting better, premiumize, and hence continue to grow the value of the business over extremely long periods of time.
Right. So essentially what I hear is it's about buying a lot of high quality businesses and staying with them over the long run and letting them compound your money for you.
So yes, high quality is the first ingredient that we spoke about, but it has to be combined with great growth.
Right.
Because otherwise what we believe happens is, if your start point is, let's say, a GFC kind of a year 2008, and you buy business with only quality, high quality, you're buying it at a discount to value, it will move up and you will catch up to the value. So in that phase you will do very well, but post that, once the value is arrived at, since the earnings are not compounding, the returns henceforth will get compromised. So quality is a great start point, but like I say, magic happens if there is a combination of quality and growth rather than only quality.
Right. The other point which most investors keep asking us is the question of price, right? Now, I know that whenever I speak about price, both you and as well as Bharat Bhai keep emphasizing that it's the value that is important, not the price. Now, most high quality growth businesses, especially in the recent past, what we've seen is they don't come cheap, they come at a price. Now, how do you look at price? I mean, is there a price at which you also sell these companies, or do you have a buy price in mind?
No, so we keep evaluating all of the businesses that we are invested into at all points in time. Our chosen method of valuation is a tweak of a DCF methodology. What we do is to assess what kind of a growth a business has to deliver over the next 10 years and or 15 years to justify the current price. Now, if the business is delivering growth which is higher than that, we are happy to hold that business. Now, it is important to understand where we come from. This is a country which has grown over last 22 years at 7.1 real, at close to 12 nominal. Okay, and in the quest of delivering what we seek to deliver, preservation and growth, we want to focus on businesses which can grow consistently higher than 12. Okay, in terms of sales growth, or at least more consistently than other businesses in terms of that. The first point itself is that you are looking for something which can grow for a long period of time. It could be basis penetration, it could be basis premiumization, it could be basis market share if you are exporting, and so on. So that thesis has to come out, and then the whole point is look at it on a quarter basis to see if the thesis is coming out right. Now, it is very interesting, we believe a lot of times that growth makes all boats go up. What people don't understand is growth can kill. Very strange but true. In 90s, two largest auto companies in the land, Hindustan Motors and Fiat, at least don't make autos today. That time total number of cars sold were 60,000 and they split the market between them. Today we do 2.5 million and they are not there. In fact, multiple other companies came in during the journey and they are there, but a shadow of their own former selves. So it's not as if growth pulls up all boats. And we talked about construction companies in 2007 and now, and all the while India has been growing. You look at businesses like BSNL stroke MTNL. In 2002, a BSNL IPO would have, the value of that business itself would have been similar to the value of our annual budget of that day.
Right.
And today, what would be the value of that business? While there has been a telecom revolution, etc., etc. So it is not that growth pulls up all boats. Growth kills many a time, and hence it is extremely important to first identify businesses, first identify managements who have demonstrated ability to not only survive with quality, but survive and grow well, gaining market share year after year after year. And that's the space to be focused on. And yes, like I said, if in those spaces you find businesses which are delivering growth which is faster than what the stock price is implying for 10 years, 15 years kind of a period, we are happy to buy and hold.
Right. At ASK, essentially, you have 5 core products. One of the strategies is quite unique, and it's been your flagship strategy for some time, the India Entrepreneur Portfolio, and it's done extremely well as well. Could you tell us a little bit about the positioning and what's so unique about it that's driven its performance?
Yeah, so this is a strategy which is frankly extremely close to my heart. Uh, it's unique in the manner that's been managed consistently in the same manner since inception. So the style purity that you see here is of a very high order,
Right.
very, very disciplined. So whatever we spoke about in terms of quality and growth is parameterized, trying to discipline the managers very well. So investing is a strange business where frankly if you give less freedoms, if you have higher discipline, the outcomes may be better rather than worse. So a lot of times we seek more and more freedoms, wanting to do this and that, but in a sense it distracts, it destroys value. This is a product which is completely disciplined. So when I say preservation and growth, do we get into turnaround stories? For example, they are supposedly able to make a lot of money for investors, but if you think through it, there may be one success, but there are 10 failures. So overall, you do that strategy, and you may not add much to a long period return of an investor. So we don't do turnarounds. We have a base minimum profit size of 100 crores, PBT of 100 crores that we have put for the fund. So it also ensures a minimum size of the business that we are looking at. It means you are letting go of the so-called rapid growth phase that a business may encounter. But once again, how many small businesses have you seen grow so well? This is a cruel market. Every market is cruel. Most of the smaller businesses die, they don't grow. So in fact, once again, if you look at portfolios of mid-cap funds in 2007 and you look at portfolios of mid-cap funds today, they would be completely different. In fact, many of the names in the portfolio,
The mortality rate is very high.
very high. So it hence makes sense to start to look at a business after it has achieved some scale. Let's say youth, that's when it's the best to start to look at them. And then the quality part. So we have parameterized it at 25%. Now that's very stiff.
Promoter holding at 25%. Indian
The
promoter.
quality, the ROC is at
ROCs,
25%.
right.
I'll come to the promoter holding part. And it is long period 25%. We don't cut corners on it at all. And then we seek out growth of over 20%. And there again, like you were suggesting, what we did was to segment the market and look at what parts of the market delivered growth better than the others. So various combinations were looked at, and ultimately, in terms of ownership, there was a clear picture which emerges, which is if somebody has skin in the game, he wants to grow that business fast enough in the process of making himself money, and people who associate also make money, as long as corporate governance is of the highest order. That is how the whole strategy got conceptualized, and I think it stood the test of time.
Absolutely. Moving on to markets, I mean, we've seen interesting times. 2017 was a fantastic year for markets. Since February this year, we've seen a fair bit of turbulence. I mean, probably partly because on account of domestic issues like elections and certain other global problems. How do you see markets from here on? I mean, and are there any underlying themes that you like from here on?
Yeah, so calling the market day to day, month on month is an extremely difficult proposition. However, if we take a slightly longer term view, I do believe these stock markets could do better over the next 4 to 5 years than they have on the index over the last 7 8 years.
Right.
So, since 2008 till now, I would believe the compounding of the index has been just about 9 odd percent.
Yes, that's the Nifty.
That's the Nifty. If we go forward over the next 4 to 5 years, what is expected is that earnings could double in the period. Now, in a combination of improved margins and growth in the country itself, which translates to profits. Now, if you look at, just to bring out similes, if you look at the period between 2001 and 2008, we saw net profit margin of India Inc. move from 1.7 to 7.1. Okay, in fact, between 2004 to 2007, from 2.7, 2.8 to 7.1. We are today at 3.1%. Now, why did that increase happen? That increase happened because commodity prices were okay. We have a fair representation of commodity. It happened because in the previous period we had a high bank charges, bank provisionings, because late 90s was a very similar period to today. And as we moved into 2000, the provisionings came down, profits of banking space increased. Third, if you remember, that was the time when we built our houses. So there was a generation shift. Loans were not available, and 2001-2 was a period when loans to retail for building a house first became available. So as the house build activity increased, there was a multiplier to the whole economy, and we saw the margins go up. Now, that kind of maps to the problems of the present: less capex, less house sales, etc. Yes, there is some amount of global tailwinds that are definitely happening. And if you take the banking thing back to 2020 and beyond, once again, if the provisionings are done between now, next year, and 2020, 21, 22, 23 would see reasonably low provisionings, profits moving to the bottom line. On top of it, if you look at what the government has been attempting in terms of low cost housing, that's a space that's been that's seeing a very strong growth. So that is already helping the economy a bit. It is the high end space which is not selling in housing. Once again, if you look at the RERA filings of most of the premium guys who are there in the market, for anything that is half done today, the RERA filings would be 2021, which then kind of means that people start to buy house anytime now, next year, and so on. So very high probability that over a next 4 to 5 years, you see a replication of what happened in, let's say, 2003 to 2007 period. So even if we don't go to 7%, we stick at 5, 5.5%, that's a 60% jump in profits by a margin increase only. On top of it, don't build a 12% CAGR in nominal growth, build only a 10%, and yet you have a doubling of EPS. So this gives you a 12 to a 13% CAGR over 4 to 5 years. Now, by various means, yes, markets are expensive by, let's say, 10% today. You normalize it over a period of 5 years, and yet it is not out of this thing that you expect a 11-12% CAGR on the index itself.
Right.
And like I said, that works out to be significantly higher than what we have seen over last 10. As far as we go, we continue to do what we do, seek businesses which grow and order higher, and hence we believe we should be in a position to deliver a sizable alpha over the index net of fees over the same.
Right. Fantastic, Prateek. Just to move on to your personal investment journey, I mean, you've spent close to 24 years in equity markets now, and you started your journey with SBI, and you were heading equities at ABN AMRO, and subsequently you joined ASK. Uh, could you tell us any interesting insights or influences that you've had in your investment journey, which has shaped your investment process and philosophy?
No, so the lot of what I shared were the experiences. So, when I started out, it was from a period which in some way was great depression in the country. 91 was when the country pledged gold.
Yes.
94 is when I came to the market, and from that position, when the economy is recovering, it seemed so easy to find businesses which could grow like even 2 years at over 50% CAGR.
Right, right.
And then you start to observe and understand because this doesn't happen forever. It is a few, it can at best happen over a few years. So that was one. There were a few interesting things as well, and I think on the journey we have realized a lot of that. So in the 90s, Indian valuations were a fraction of US valuations, half or less than half. And everything you studied in college, seemed to be working for India and not working for the West. Their quality was worse than ours. We were making higher ROEs. We are supposed to be growing faster. Our outlook was much better, and yet our P's on the index was like 8, 9, 10 in those years. And US used to be 18, 19, 20 for everything. And it became a habit for everybody who was doing research then to compare Indian valuations with global valuations, and we used to look like half of globe. So now all of that has changed. We are in line with global valuations in most cases, if not higher. So I do believe that was a great journey that's been run. And of course, it's that realization which also makes one believe that going forward, what to expect, what kind of businesses to back.
Right.
That's changed. So that example about 2007 and now, both in terms of mid-cap mortality and even sectors which do not have a moat.
Right.
And even the leaders don't exist in the next cycle. Those are learnings that are not probably easy to forget and won't be forgotten.
Right, right.
So I keep saying, late 90s, early 2000s was the age of innocence for managers. Practically all of us came into the market at that point in time. Gave a benefit of doubt to everybody, but now after 22 years of having 6,000 companies in the marketplace,
Right.
if just about 300 have over 300 crores of profits, then I think the market already knows who is good, who is not. And the whole idea is to focus on the good part rather than what is not.
Right. Prateek, lastly, I mean, we have a tagline of knowledge first, and all of us are avid readers. Any books you would recommend to our viewers on investments?
No, read is something which is good. It could be anything which can be very different from yours, makes you a much better individual. So, it could be fiction, it could be science, it could be even investing. Learn, but don't follow. A lot of times I see people trying to emulate somebody else. My whole thing is to understand, learn how somebody else did it. Your setting may be different versus somebody else's. What worked, what did not work, and then try and dovetail it into what you are trying to do. I think that is important rather than just following and.
Thank you, Prateek. It's been a very enriching conversation for me.
Thank you.
And I'm sure there are a lot of takeaways and insights for our viewers as well. Thank you very much for watching this second version of Know Your 4C Manager. This is our endeavor to bring you winning managers to create winning portfolios. There are several insights that I drew from the conversation today with Prateek, who's CIO for ASK Investment Managers. Basically, buy quality with growth and don't avoid mistakes as far as possible. If you wish to write into us or give us any feedback, you can write into our email ID, follow us on Twitter, or watch our YouTube channel. Thank you very much.